Beginner Investing Principles, starting with the basics for beginning investors. Materials provided by Genesis Financial Management. Congratulations! Since you're here, it means that you're taking control of your finances. Most of us wish that we could save and invest, but haven't the slightest idea on how and where to get started. Well, it's time to start to learn how to save, invest, and make your money grow. First things first, are you ready to invest? Do you have an estate plan, an investment plan, home ownership, risk management plan, emergency fund and credit access, solvency? Before investing, your income should exceed your expenses. If you have debt, you should eliminate expensive debts and pay off credit card debt. You should get adequate insurance, so home, health, liability, life. You should have an emergency fund. Start with saving. An emergency fund, you can cash the value of a life insurance policy, equity in home, fund for large purchases, long-term savings for future goals. Develop a budgeting plan. Budgeting is vital to any saving strategy. It helps to identify where your money is going. Wasteful consumption patterns can be controlled through successful budgeting. Often a simple spreadsheet in Excel would suffice. In fact, you can use the budgeting template that's already available. I don't have any extra money to save or invest. Challenge yourself to find missing money. Try these 3 options. Get your employer to help with an automatic 401k investing, direct deposit into a savings account, invest automatically, find extra cash, adjust withholdings, advance EIC payments, raise deductibles on insurance policies. Saving and investing differ. Savings are safe, they're easily accessible, they have a low return, and they're typically for short-term goals, whereas investing involves risk, can be volatile especially in short time periods, has a potential for higher return, and typically made for long-term goals. Identify your goals. A short-term goal, an example would be an emergency fund. You need to access the money, so there has to be liquidity. It needs to be safe. You won't lose your principal. Whereas an intermediate goal is something that you save for 1 to 5 years away. An example would be a car or a special vacation. Long term, an example would be 20 years or retirement. Understand risk versus reward. Here's another way of looking at your investments. Your base funds are the most critical for your welfare. Those are located right here. They should be invested in low-risk funds. As you become more financially secure and have more net worth, you can invest in mutual funds containing stocks, bonds, or real estate trusts that have higher returns, which is located in the middle right here. Most of us never reach the summit of financial security where we can afford to take the risks associated with individual speculative stocks, options, future contracts, and collectibles. But if your middle-level investments turn out to be very successful, there's always that possibility. Many types of risk. Inflation risk, the loss of purchasing power. Liquidity risk, ease of buying and selling. Market risks, higher inflation, political climate, world events. Interest rate risks, devalued investments due to market fluctuations in rate. What's your risk tolerance? Without some risk, gains will be limited. Consider your time horizon. The longer you plan to keep your funds invested, the more aggressive you can be with your investment dollars. Time value of money. The relationship of time, money, the rate of return, and their impact on savings growth. The more time you have to save, the more money you will have. The more money you save, the more money you will have in the end. The higher the rate of the interest, the more money you'll have at the end. Money grows over time, so it's important to start early. Compound interest pays additional interest on your earned interest. So the earlier you start, the longer you have to accumulate that extra interest. People who begin investing early in life have a huge advantage over those who start investing later. Let's take a look at an example. We've all seen it done on television cooking shows. They put raw food in the oven, and thanks to the magic of television, they immediately pull out a fully cooked dish, piping hot and ready to serve. Actually, compound interest and reinvestment of earnings works in a similar way. It just takes a little longer. You invest $1 into an account, and thanks to the magic of compound interest, you have $2 or even $3 to withdraw. How much later? Here's an interesting fact. If the Native American tribe that accepted 60 guilders for the sale of Manhattan in 1626 had invested that money at a 6.5% interest compounded annually, their investment would now be worth over $820 billion, more than the value of all real estate in New York City. Rule of 72. This illustrates the dramatic effect of time and compounding. Your money will approximately double at a point in time determined by dividing 72 by the percent of interest you earn. Making sense of your options. We'll be talking about workplace retirement plans, IRAs, stocks, bonds, mutual funds. Retirement plans in the workplace. Defined benefit plans or pension plans. Defined contribution plans are 401ks, which private companies offer, 457bs, which local and state governments offer, and 403bs, which charity and nonprofits offer. Deferred compensation. They're tax deferred. Maximum pre-tax contributions in 2014 was $17,500 under the age of 50, and 50 and older was $20,500. You should at least contribute something. Increase contributions as salary increases. Nonprofit and private sector often offer matches. So your company is offering free money. Let's take a look at some of the concepts behind this offer, because you don't want to turn down free money, but you need to understand how it will be invested. 401k money is generally invested in a mutual fund. This is a great option to minimize risk and diversify your holdings, but you generally have the option of choosing among several types of funds, so you may be able to actively participate. You can move money between funds to choose a comfortable level of risk versus trying to optimize returns. The results are in your hands, and how much you receive each month in retirement is dependent upon the options chosen today. Here's an example. Money is invested in mutual funds, sometimes in funds containing company stock. Employees are offered several funds to choose from with varying levels of risk and diversification. Employees may move money between funds to increase returns or reduce risk. Retirement plans and match. Some companies match a percentage of each dollar contributed up to a given percentage of the employee's total pay. Here's an example. A company might match 50 cents for each dollar an employee pays in, up to 5% of the employee's yearly salary. Money matched is yours after a vesting period. Remember, with defined contribution plans, there are guaranteed tax advantages with 401k contributions. It immediately reduces the amount of your paycheck by the amount deducted for your contribution. So you are taxed on a lower amount each payday. And we've all seen what a bite taxes can take out of our paychecks. Also, the interest earned on a 401k account is not taxed as interest income each year, which means it won't inflate your yearly income for tax purposes. And finally, you pay taxes on the amount you withdraw after retirement, when you may be in a lower tax bracket and would therefore pay less in taxes on the same money that you would while working. Of course, you can't withdraw the money until retirement age without severe penalties. You'll lose 35 to 45% of your total investment, including the earned interest. So save the money you need for retirement here and take advantages of the pluses such as company match and tax advantages, but don't plan on accessing the money until you retire. A couple things to remember. The account earns interest tax-free until you withdraw the money. If you withdraw the money before the age of 59 and a half, you'll likely pay a penalty unless there are special circumstances. Only invest money for retirement and don't plan on accessing this money any sooner. Individual retirement accounts or IRAs. Traditional IRAs, the contributions may be tax deductible. Tax deduction on contributions depending on income and if covered by retirement plan at work. Pay taxes when you withdraw at 59 and a half years old. Tax penalties for early withdrawal. Roth IRAs. The contributions are taxed. Withdrawals are not taxed. Contributions are made after tax. Interest accumulates tax-free, withdrawals not subject to federal income tax, and it's a good option for those who expect to be at a higher tax bracket in retirement. So the main difference between traditional IRAs and Roth IRAs is that traditional IRAs are not taxed up front, but are taxed when you withdraw, and Roth IRAs are taxed up front, but not when you actually withdraw. Stocks. A stock is a type of investment that represents ownership of a company. A stock is created by companies issuing shares to raise capital. The shares of the stock are a claim in the company's earnings and assets. Shares of stocks are represented by stock certificates. There are different kinds of stock. The most familiar variety is common stock, which gives the owner voting rights in the company. Here's an example. Let's say a company is valued at $1 million. If the company's ownership is divided into 1 million shares, each share is worth $1. If it's divided into 25,000 shares, each share is worth $40. For our example, let's say each share is $40 and you have one share. The company suddenly invents a hot new computer widget that everyone has to have. So they make lots of money and expand their business. Now the company is worth $2 million. Since the value has doubled, the worth of your share has doubled to $80. That's a pretty simplistic example to give you the basic idea of how a stock works. And here's another. Suppose the widget fries everyone's hard drive. All the widgets are returned for refunds, plus the bad publicity, and the company is being sued by customers and distributors. The company goes out of business and now is worth nothing, zero. What happens to the value of that stock? That's right. 1 over 25,000 of zero is zero. Your stock is worthless and you've lost your money. That's why we have to be careful investing in individual stocks. They can be among the riskiest investments of all. Bonds. Bonds are different from stocks. Rather than owning a piece of the company, you are advancing a company your money for their use with the understanding that they will pay it back plus a set amount of interest at the end of a period of time. Since bonds are often issued by governments from federal to local, you can be pretty sure that they will be around to repay you. You purchase a bond for a set amount, and at maturity, the issuer will pay it back with interest. Interest is specified when you purchase a bond, so it won't change or decrease. You don't have the fluctuations you have with the stock, since the bond market is often rising when the stock market is falling and vice versa. Bonds make a good complement to stocks in a diversified portfolio. In fact, many mutual funds include bonds in their portfolio for that very reason. Mutual funds. It's a combination of several stocks and joint ownership between members for a fund. Sometimes it includes bonds or money accounts for greater diversification. Safer than individual stocks and bonds. There's a professional fund manager that makes decisions and actively invests for its members. There's safety in diversification, and mutual funds are one of the safest options for long-term investments. When you buy into a mutual fund, you become joint owner with all the others who have invested in that fund. Together, you all own stocks in several different companies and maybe also have shares in bonds, money market accounts, or real estate trust. That makes this a great next step in investing after your emergency fund is built. Your fees go to pay an experienced fund manager who makes the decision on when to buy and sell each stock, so the fund is actively managed without you taking on that responsibility. And since you have a combination of stocks from various companies and even various categories such as retailers, energy companies, tech companies, etc., you are protected if one stock falls in value. Arm yourself with knowledge. If you're going to invest in stocks or bonds individually, research companies until you understand them. Consider joining an investment club. Examine historical data or participate in a stock market simulation. If you don't have time, consider mutual funds, especially index funds. Dollar cost averaging. One of the best ways to grow your money while minimizing risk of highs and lows. It stresses the importance of investing the same amount of money on a regular basis over an extended period of time, regardless of what the market is doing. Here's an example. The total amount invested was $300. The number of shares owned is 35. The average cost per share is $8.57, while the average price per share is $11.66. End result. You end up buying more shares when prices are low and fewer when the prices are high, ultimately paying less per share than the average share price for the period. Cost of investing. There are costs associated with investing. These costs vary across types of investments and even within the same investments, so we should try to minimize the costs as much as possible while still choosing our best options. If we purchase stocks, we will pay fees to a broker who handles that transaction. Of course, we want to find a broker who charges the lowest fees, but many of these discount brokers don't provide the level of service where you can ask questions and rely on them for support. So if you're new to stocks and want the ability to pick up the phone and talk to your broker, you may want to pay more in fees for that support. If you're comfortable with investing, you may choose a discount broker. And in mutual funds, no-load funds still have fees, but they lack the upfront commission charge. So choose a fund that offers the best combination of low fees, no load, high returns, and a level of professional oversight that makes you comfortable. Mutual fund overseers hire a professional manager to decide which stocks and bonds to buy and sell, and they pay fees when buying and selling. These management and operating expenses are paid for by the shareholders by taking your share of these expenses out of your returns, lowering your returns by the amount of the expense ratio. In effect, the lower the expense ratio, the greater your returns. A well-managed and efficient fund should have an expense ratio below 1, and funds with an expense ratio greater than 1 may be reducing your returns. What do the letters mean? Though credentialing for financial planners is not required by federal or state law, you should expect the person calling themselves professionals to have the appropriate educational background, have significant professional experience, be licensed by the appropriate government regulatory agency, and have a commitment to helping others. A number of certifications and designations exist. Certified Financial Planner. It's probably the best known certification in the field of financial planning. CFP licensees have to complete study and pass examinations in risk management, investment, tax planning, retirement planning, and estate planning. They must also have a minimum level of 3 years work experience, continue to update their knowledge in the field, and adhere to prescribed codes of ethics. CFP licensees are certified by the Certified Financial Planner Board of Standards. Chartered Financial Analyst. These designations are awarded by the Association for Investment Management and Research. 3 levels of examinations can be taken. For example, the first level includes understanding investment analysis and management, financial markets, portfolio management, and securities laws. Chartered financial consultants. They complete courses in economics, investments, insurance, taxation, and related areas from the American College in Bryn Mawr, Pennsylvania. Personal financial specialist. These designations are obtained by some certified public accountants. Additional specialized education is needed, and other requirements established by the American Institute of CPAs must be met. CPAs with the PFS designation provide a broad range of personal financial services, which may include investment advice. Accredited financial counselors. They must pass 2 examinations, one in personal finance and one in financial counseling, and subscribe to the AFC Code of Ethics. Whatever his or her credentials and certifications, a true financial planner should be able to analyze your family's total needs in such areas as investments, taxes, insurance, education goals, and retirement. They should be able to pull all of that information together into a cohesive plan. The planner may also help you select and prioritize goals and then rearrange assets and liabilities to fit your lifestyle, stage in life cycle, and financial goals. Costs. It's important that you be told clearly, preferably in writing, what the fees will be for the variety of services the financial advisor will provide. Financial advisors can be paid through a variety of structures. Salary. The financial professional receives a paycheck from the firm. The firm receives its money from fees or commissions charged to the client. Fees. There may be an hourly rate, a flat rate, a percentage of assets managed by the firm, or a percentage of your income. Fee-only financial advisors work solely for their clients and are compensated only by an agreed-upon fee. They do not accept commissions, nor do they receive any other compensation for recommending specific products. Commissions. These are paid to the financial professional when recommended financial products are purchased. Commissions are generally based upon a percentage of the amount that you invest in the product. Combination of fees and commissions. A financial planner may charge a set of fees to develop an investment plan for you and receive commissions from any products purchased to implement your plan. The best financial professional for you is a well-experienced and qualified one, understands your financial goals, understands your risk tolerance and capacity, accepts your budget, speaks your language. How to choose a financial planner. A financial planner can help you with your overall financial goals. Before you choose a financial planner, here are some questions that you should ask. What are your credentials? Ask them about formal education, certifications, and professional association memberships, as well as continuing education. How long have you been in the financial planning field? At least 3 years experience is desirable. How long have you lived in this community? What references can you provide for your professional reputation? Also ask for at least 3 client references. What services do you offer? Some planners may offer advice on a range of topics but don't sell financial products. What is your approach to financial planning? Make sure the planner's viewpoint on investing is not too conservative or aggressive for you. Will you be delegating any of the work you do for me? If so, to whom and at what rate? May I see a sample of a financial plan? What are your fees? Try to find out what the range of fees should be for the type of professional you're hiring. Also ask if he or she earns commission. If so, from whom? Will there be a written contract? A contract is essential to confirm your fee and service agreements, unless you pay for each visit individually. The contract should list the task the professional is to perform, provide an estimate of fees or a statement of how charges are made, and explain how you will be billed. Choosing a broker. Many stock transactions for individual investors are handled through a stockbroker. Most brokers are honest, qualified professionals. If you are in the financial planning stage that you find yourself in need of a broker, it's important that you find the broker that makes you feel comfortable and that can best meet your needs. The National Association of Securities Dealers helps to make sure that stockbrokers who are not trustworthy are identified, disciplined, and barred from the industry if necessary. If you are a more experienced investor and know which securities you want to buy or sell, you might consider a discount brokerage firm that charges a minimal fee for simply executing the transactions that you have selected. Online investing services are the latest trend in discount brokering. Selecting a broker is similar to selecting a financial planner. Find a firm that offers you the services that you need, that is safe and reputable, that provides its policies and fees structures in writing, and most important, that it's a place that you feel comfortable doing business after checking the background of the firm. Background check. Investigate the background of any financial professional you're considering. You can contact the CFP Board of Standards, the National Association of State Insurance Commissioners, the North American Securities Administration Association, the National Association of Securities Dealers, and the Securities and Exchange Commission. Questions, comments, experiences. If you need to speak to one of our certified personal financial counselors, you can call us at 877-202-9246 or visit us at www.yourgfm.org.